Okay, so good morning. Yesterday we were talking about options, right? We were in the middle of options and we were talking about the basic building blocks of options, call options and put options. Call options were what? Call options were the right for the person, for whoever was buying that call option, the right to buy an underlying asset in a future date, at a future point in time, at a pre-specified price. This pre-specified price we call the exercise price. Exercise date was the pre-specified date. So at the exercise date, at an exercise price. But it was the right to buy. And on the other side of the transaction stood a seller who had the obligation to sell. That seller we call the writer of the option. We have the option holder who has the right, and the option seller who has the who is the writer, of the option. And then we spoke about put options. Put option was the right to sell. So the option holder had the right to sell the underlying asset at a certain exercise date at a certain exercise price. While on the other side, there was the buyer who was obligated to buy what was being sold on that date at that price. So the writer of the option, in a put option, the buyer, in a call option, the seller, the writer of the option does this for what we call the option premium, the option fee, option premium, price, right? Call option price. These are different terminologies that we use. So within options also, we spoke about how you exercise it. Do you exercise it exactly at the exercise date? Anytime before the exercise date, on specific dates, which is what we spoke about when we spoke about European options, American options, and Bermudan options. European options always happen at the end of the period. At the exercise date, you figure out, do you want to exercise this option or not? Versus American options can be exercised anytime before the exercise date, and Bermudan options can be exercised or on pre-specified dates, multiple dates. You have multiple dates where you can decide whether you want to exercise the option or not. But it's not every day. So we spoke about in the money, out of the money, and at the money options. Call options and put option both can be in the money, out of the money, or at the money. In the money means it is profitable to exercise the option. At the money means you are neutral because you can exercise the option or you can buy it from the market. You are neutral. It is exactly at the money. It is exactly at the market prices are exactly at the exercise price. And out of the money means it is not profitable to exercise the option. If an option is out of the money at the time of maturity, you will not exercise. Then we spoke about how the payoff and the profit, what the payoff means and the profit means, right? Payoff meant what? Payoff meant whether you're checking whether it is profitable to exercise the option or not at the end of the period, at the time of the exercise, right? Why I say at the time of the exercise is if it's a European option, it's always at the end of the period. But if it's an American option, it is not necessarily at the end of the period, right? Because any day you can decide whether to exercise it or not. So at the time of deciding whether to exercise or not, is your option profitable to exercise? This is without taking the fee that you paid into consideration. The fee meaning the call option premium or the put option premium into consideration. So what is the payoff? The payoff for a call option is the price at the time of exercise minus the exercise price. If this is positive, this is the payoff, or zero. Why? Because if it is negative, we will not exercise it. Remember, how does the payoff for a call option holder look? You look at the exercise price You look at the market price. Where the market price is greater than the exercise price, it is profitable to exercise it. It's in the money. So you would exercise it, and the profit that you get is ST minus X, the market price, difference between the market price and the exercise price. That's the payoff. We don't call it the profit, it is the payoff that you make. Below this exercise price, you are out of the money. You will not exercise the option. You will never go negative, right? So for an option holder, you will not exercise the option if it is below the exercise price. And when you look at the profit of an option holder, to get this, you are looking at what is the profit? The profit for an option holder is always the payoff minus the fee, right? These are both for an option holder, the payoff minus the fee. So the payoff minus the fee for the option holder, always he will pay a fee to get this benefit. So because of this, from this payoff, you have to deduct the fee. So until the point of exercise price, you will be in negative territory when you look at your total profitability of the transaction, because you have paid something to buy this right. Okay. After the exercise price, right, that's essentially the fee reducing your positive payoffs or zero payoffs. After the exercise price, you start to have positive payoffs, but your loss starts to come down. And at one point, you will break even. So this is what the profit for an option holder will look like.
Excuse
Correct.
me.
Go ahead.
It's what's denoted by ST?
ST is the market price at the time of exercise, at the end period.
Right.
S0 is today. ST is at the end.
Market price. And then the
Market
exercise
price.
price. So,
S stands for spot prices.
and X is the exercise price.
X is the exercise price. Yes.
Okay, thanks.
So this is standard terminology because we use for option pricing equations and all that. Yesterday there was a question that was asked, how do you figure out the option premium and all that? So there are standard terminology that we use. This is why we use the terminology ST. S stands for spot. So you have S0, ST. S0 means spot prices today. ST means spot prices at expiring. Sorry, there was another question. Strike price and exercise price, same thing. It is strike price. I think it's mentioned here. Somewhere in these notes, it was mentioned that strike price. Anyway, it's the same thing. It should be somewhere here. Here. I'm used to calling it the exercise price because of the terminology X, but strike price, exercise price, same thing. Okay. And when you take the writer of the option, so when I take the writer of the option, the writer faces the opposite of the holder. So his payoffs are exactly the mirror opposite of the holder of the option, right? So his payoffs are, if the holder of the option looks like this, the writer's payoffs look the mirror opposite. Remember, the writer has a opportunity to get positive payoffs here, but he can't because the holder is the one who has the right. So always remember, on the writer side of the equation, you look for the holder, and the writer is simply the mirror opposite. The writer is simply an incidental person because he cannot make any decisions. All his decisions are dependent upon the holder's decisions, right? So I know that some of you, especially those of you who are not speaking, right, may make this mistake. A lot of the time, you will see that they will think the writer will be making a profit. He could be if the holder didn't decide to cancel the contract, right? Not exercise it. But the holder, because it's not profitable for the holder, they won't exercise the contract, and therefore the writer never makes that positive payoff. He never makes that positive payoff. He can make a positive profit. Because what is his profit? He charges the fee upfront. So his profit is payoff plus the fee. Plus the fee. So his profit is up to the exercise price, he will make a positive profit. Above the exercise price, his profit starts to disappear, and he can still make losses depending on how much the stock price or the underlying price moves by maturity. So this is for a call option. How does it look like for a put option? For a put option, you are looking at the right to sell. The right to sell. Okay. So you want, essentially, what you're saying is, in case prices start to come down, you are at a higher price looking for and having the ability to sell. So as long as the exercise price or the strike price, as long as the exercise price is above the market price at the time of the option expiry, you're better off. So you're in the money in this region, and you're out of the money in this region. Okay, this is where you are exactly at the money. Okay. What happened? Right. So when you look at the market prices at the time the contract expires, if market prices are below your exercise price, that means you have agreed, or you have the right, not agreed, you have the right to sell at a certain price. And market prices are below, so you're better off. So because of that, you are in the money when market prices are below your exercise price. Actually, you make a profit of, or payoff of, not profit, payoff of X minus ST. X minus ST. Because your market prices are below the exercise price, and that's when you make positive payoffs, or zero, because you will never make negative payoffs. You will never make negative payoffs, right? So X minus ST, meaning when prices are in the money, you will keep on making positive payoffs. And when prices are out of the money, you make negative payoffs, but you will not exercise the contract. Therefore, your payoff is zero. That's your payoff. What is your profit? Your profit is your payoff minus the premium, the put premium that you pay to get this privilege, this right. Okay. So what is the profit profit is so it comes down by the amount of the put price, the put price or the put premium. Same way for the put writer, his payoff is so this was for the holder. So for the writer, his payoff is the negative of what the holder will experience. Negative of what the holder will experience. Therefore, until the exercise price, his negative payoffs. Above the exercise price, he could have got positive payoffs if he was in a futures contract or a forward contract, but because he's in an options contract and the holder expires the contract without exercising it, he makes zero. That's his payoff. His profit is what? His profit is his payoff plus the put premium. So because of this, his profit, these are all parallel lines, please, increases up to the put premium. So his negative comes down up to the put premium. And from that point onwards, he's making positive profits. From this point onwards, he breaks even. Okay. So just to put that into context, let me just quickly show this again. Call option payoff. Oh, what did I say? Call option, right? Exercise price, ST, payoff. I'm not drawing the what do you call it, the profit diagram here, because I want to show something else, right? The payoff for this is the holder, this is the writer. The payoff for the writer looks like that. That's for a call option. For a put option, this is the payoff for the holder of the option. Okay. And the payoff for the writer of the option. Now, if I combine this, just to make a point here, if I combine this is the call option holder, and this is the call option writer. And this is the put option holder. Sorry. And this is the put option writer. Just as a tool to remember, okay, always, so the holder is positive, writer is negative. Holder is positive, writer is negative. But just as a tool to remember, for the call option, you see a C here. And for the put option, you see a P. It looks like a C and it looks like a P, just to remember. And then obviously when you come to payoff, you have to make those adjustments accordingly. That's all. Okay. So these are everything that we talked about. All of these we talked about, right? Payoffs for call options, ST minus X or 0. Payoffs for put options, X minus ST or 0. And then pay off minus purchase price for holders, pay off plus premiums for writers. So we come to option strategies. Now you can buy calls and puts on your own. You can do that, right? When you think stock prices are going to go up, you don't want to buy the share today. You might want to buy a a call option later on, for later on. Meaning you think share prices are going to go up, but you're not certain. Because you're not certain, what do? You buy a call option today. You spend a little bit of money because that's the option premium that you spend. And you say, I take the right to buy the call option in 3 months' time at this price. So just in case prices have gone up in 3 months' time, you can exercise and you can actually buy the call option. Same way, if you think prices are going to come down, but you're not certain, without selling the shares today, you can get the option to sell the shares in the future at a certain price so that you're not making losses. So you can do plain vanilla call option buys, sells, put option buys, sells. If you want to, for example, if you don't think share prices are going to go up too much, you can be the writer of the option and give somebody else the right to buy the call option because you're going to earn money. You're going to earn money by the option premium. Of course, you will lose money if your assumptions are not correct. But a lot of the time in options trading, what you will see is it's option strategies that are more popular, where you combine the underlying asset plus the call options and put options in different ways to come up with different strategies. Some popular strategies, for example, are protective put. You don't need to know the names. Okay. We'll do some examples. What you will have in your exam is to be able to, when an option strategy is given to you, you should be able to individually look at the components, and for each component, figure out, are you in the money, at the money, out of the money? What is your profitability or your payoff? And accordingly, for the entire strategy, figure out what is your profitability or payoff. But I'll just introduce a few strategies to you. It is not going to be tested in the exam in the form of what is a protective put, what is a strategy, or something like that, right? So a protective put is essentially where you have the underlying stock with you and you purchase a put option. This actually, when you purchase a put option and you have the underlying asset with you, it creates a synthetic call. Protective put looks like that because a put option looks like this, right? That's what a put option looks like. And you buy and you have the stock with you. The stock also, if you draw it in the same graph, the stock also will do better for you because you're long the stock, you have bought the stock. It'll do better for you if the prices are above the price that you purchased it, and worse for you if the prices are below the price that you purchased it. So if you look at, this is positive, this is negative, positive, negative, right? And then this is zero, this is positive. So when you add these up, you will see that this to this will cancel out. So you'll get something like okay. So up to this point. Sorry. So this looks like a call option. So it's actually a synthetic call option, right? What are you doing by this protective put? By having the stock with you and buying a put, simultaneously purchasing the put with your stock. Why do we say simultaneously purchasing the put with your stock? Because otherwise you can just purchase a put without the stock for speculation purposes. But if you want to hedge, you have a share. You don't want the share prices to come down, right? Therefore, what will you do? Or when share prices come down, you want to have a hedge. Therefore, what will you do? You will purchase a put. You will go long on a put, hold it. When you purchase a put simultaneously with the share, what do you see? When the share prices keep coming down, you still have positive payoffs. Positive payoffs, right? But when the share price goes up, you make that gain. So this is what we call a protective put. Same way, you can have a covered call where you're investing in the stock simultaneously with the sale of a call option. So a covered call, you can see, looks a little bit like a put option. Put option. You sell a call and you have the stock with you. So what happens? This and this, when you add 0 and negative, it's still negative. 0 and negative, it's still negative. Up to this point, it's negative. Then what happens? So, sorry, 0 and positive. Up to this point, it keeps, you see a line like this. And then from this point onwards, this plus this, you start to see a straight line. Okay. You are not required, essentially, you should be able to understand how these work, right? You don't necessarily need to draw the graph, but once you do a few payoffs, you should be able to understand how the graph will look like. So a straddle, long call, long put. Long call means you are the holder of a call option. Long put means you are the holder of a put option. So holder of a call option, holder of a put option. What does your strategy look like? Now, this plus this plus this plus this is simply that and that, right? That's your strategy. So what does this strategy mean, especially in a straddles type of strategy? Sometimes we call this butterfly for the other side, right? In this straddle strategy where you are a long call, long put, you are assuming that share prices are going to go up or down in large movements, but not in small movements. Okay, not in small movements. Why do we say that? Because you are at a profit if share prices go up a lot or come down a lot. But in between, if it stays at expiry in between, you will be making losses. Right? Why do I say that? Look at this again. What's the strategy? You do a long call and a long put, right? At the same exercise price. Same exercise price. This is your payoff diagram. If I draw your profit diagram will look like and for the put option, the profit diagram will look like sorry. Right. Yes. Okay. So what does your diagram look like? What does your profit diagram for the straddle look like? This plus this is this. This plus this is here. So your straddle diagram, profit diagram looks like that. Okay. What do you see here? At expiry, okay, if your share price, or whatever the underlying price, it doesn't have to be shares, whatever your underlying price is between, let's say the exercise price is 70 and this is 80 and 90 because your cost was 10, right? If your price of the underlying is between 80 and 90, you will be making losses. But if your price of the underlying moves a lot above 90 or a lot below 80, you are making profits. So this is good for a situation where you're investing in something that you're taking a huge bet. You think that something big will happen, positive or negative. If, for example, let's talk about a company is doing a project, and if that project works out, the company is going to do really, really well. But if the project fails, the company's share prices are going to crash. Then on that company, you can do an option where you buy the call on the company at the same exercise price, you buy the put on the company. And what do? When you combine them together, you have a situation where you will make a profit whether the company goes up or down. But in between, if the company prices don't move a lot, you are making losses. Same way, you can do a reverse straddle. Where you sell a put, sell a call, and you sell a put. Right? What do you see when you look at the profit diagram of the two? You see that the profit diagram looks like that. Now what do you see? If the company prices move a little bit up or down, you'll be making profits, versus if it moves a lot up or down, you'll be making losses. So there are a lot of different strategies that traders will use where they combine these call options and put options to create different strategies, right? Let's look at one. Let's try this example. Try the first part. First part is not a strategy. It's simply a plain vanilla call option or put option. I can't remember. Or I think you're supposed to figure it out. Confusions, let me know. Correct. 55, yes. So, Miraj, I think you had to, your first part is definitely correct. Second part is not that it's wrong, but it's the full numbers. It's not per contract or per barrel. 55, yes. BBL stands for barrel, per barrel. Yeah, Miraj, yes. So, this first part, yes, Johan, correct. Divanka, yes. Only thing is, 55 is, I don't think your cost is right. Yeah, your 55. Final answer is not, cost is not correct. Okay, yes. Johan, yes. So the same thing, it's on this side, just to make our just to have room for calculations, right? So it's the first part that I've rewritten here. Same question. So an oil trader is worried that oil prices will increase. He's scared that oil prices will increase. He's a trader, he buys oil and sells it. So because he's buying oil and selling it, he's worried that if oil prices go up, then his margins will come down, right? So he's worried that he wants to hedge oil prices going up. So he wants to hedge his risk. He decides to do hedge by buying June expiring call options. You are correct. June expiry call options at exercise price of 85 a barrel. So he's buying the call options. He's the holder of call options at 85 a barrel. Premium of $3 a barrel. That means the fee that he's paying. He's paying $3 a barrel. So the expiry of this option, whatever the date that he's purchasing it at, because we haven't mentioned what date he's getting into these contracts at, but in the future in June, okay, so maybe next June, the exercise price of 85 and a premium of 3. Each option calls for 1,000 barrels. So one contract equals 1,000 barrels of oil. So if he wants to hedge his position is 1 million barrels. He wants to be able to buy 1 million barrels of oil at $85 a barrel. Wants to be able to buy 1 million barrels of oil at $85 a barrel. But because these options are traded on an exchange, they're standardized options. How many contracts does he need to buy, right? Does he need to hold? He needs to hold 1 million. He wants to hedge 1 million barrels of oil. Each contract is 1,000 barrels of oil. So therefore, he must purchase 1,000 contracts. So when their contract expires in June, now assume that oil prices are 90. What is his payoff? What is his profit? So he's bought a call option. You can decide whether you want to do it through equations or whether you want to do it through drawing the graph, right? He's purchased a call option. So in a call option, what is the exercise price? 85. Now, when the contract expires, oil prices are 90. Oil prices are 90. So he's in the money because he has the right to buy oil at 85. Market prices are 90. He's better off. He can buy oil at 85. So he's better off. He's better off by $5. $5. That's his payoff. Per contract, $5. Sorry, per barrel, $5. That's his payoff. Payoff is $5. So he has 1,000 contracts. Each contract is for 1,000 barrels. So his total payoff is $5 million. That's his payoff. What is his profit? His profit is the fact that he paid $3 at the beginning of this transaction. So his profit comes down by $3 to 2 per barrel into 1 million barrels. So 2 million profit. 2 million profit. Okay. Here also, you can decide, not you, the exchange will tell you whether these options need to be settled physically or cash settled. If it is cash settled, you get cash of 2 million to your hands. If it is physical delivery, it's simply a hypothetical profit because you would have purchased it at 90, but now you're purchasing it at 85 and you've paid $3 at the beginning of the contract. Okay. Any questions so far? What is the trader's ultimate cost? What is the trader's ultimate cost? He, when he buys oil in the market, due to his hedging position, what is his ultimate cost? He buys oil in the market at 90. But because of his hedging position, he gets 2 million to his hands. He spends 90 million to buy oil, 1 million barrels of oil at 90 barrels a dollar. Sorry, $90 a barrel. And he gets 2 million to his hand. So what is his ultimate cost? 88 million. Do you see, no matter what the price of oil is, this will always be the case. His cost will always be 88 million. Because if the price of oil is 90, what will happen? If the price of oil is 90 in the market, he will have a profit of $2, and therefore his cost will be 88. If he is at the money, if the price of oil is 85 in the market, if he's at the money, when the contract expires and the price of oil is 85 in the market, he does not have any profit, but he has to pay this $3, or he has paid this $3, right? So that's an additional cost to him. That's an additional cost to him, which makes his total cost 88. Right? And if the price of oil is 80 in the market, what happens there? If the price of oil is 80 in the market, what happens there? What is his cost? What is the cost to him if price of oil is 80? Is his cost. So therefore, he won't exercise. You're correct. So he won't exercise, but he'll buy oil in the market because anyway, that's his business, right? So he didn't spend $80 to buy oil in the market. He has paid this premium of $3, so that's a cost to him. So in total, his cost will be 83 million. If the price of oil is 70, his cost will be 73 million. 73 million, right? If the price of oil is 82, his cost will be 85 million. Now, do you see from 88 million, his cost, as long as oil prices keep on going up, his cost is fixed. His cost is always going to be 88. But when oil prices keep coming down, his cost actually comes down because of the options contract. Now, in a forward contract or a futures contract, this was not the case. In the forward contract or a futures contract, when prices came down also, you were fixed at 88. You had to, the total cost to you was 88, right? But meaning you lost in that position, you lost. There was an opportunity cost to you. But here, because you can walk away from the contract, you actually get the benefit of oil prices coming down. So you are a trader, you are buying oil and then selling it. So you want to make sure that your costs are low. You don't want, when oil prices go up, you don't want to have that additional cost. Additional cost of the fact that if oil prices go to 90 to 100, then that becomes a problem for you. So you want to hedge your risk. So what do? You buy a call option. And because that call option, oil will always be 88 for you because the exercise price was 85. And the price that you paid at the beginning of the contract, the call price, was 3. So the total cost to you per barrel is 88, and it will remain 88 for you if oil prices go above 85 at expiry. But when our oil prices are coming down, it will not remain 88 for you. Your cost will actually come down. Only thing is, you still have a higher cost than the market prices because of the premium that you pay. But otherwise, you are now able to take advantage of the fact that market prices are coming down. Any questions here?
Madam, if we compare these three, I would say it is three situations. For example, the first one is we don't have this kind of instruments. We are exposed to market risk. That is the normal. So if I am going to do a transaction, I will face the market risk. That means I would earn higher profits or would be lost. Using future or forward contracts, the second level or the second situation, I can still manage my profit or the loss to some extent by having the contract with a specific price. Still, I would gain profit or still I have to make losses. In the third level, that is the option, I would always have the option to avoid the loss part and always be in the profit side, or if the market is against me, I would have zero cost. I'm not considering the fee. Is that the
Yes and no. So yes and no, because when you take a forward, what you're doing is creating price certainty. Even with options, what you're doing is creating price certainty. It's about the fact that, especially when you want to hedge the fact that, let's say you're quoting an order, right? Let's say for a textile manufacturer, right, an apparel order, you're quoting for your next order and you want to know your raw material costs, right? Then it's not oil, whatever, your raw material costs. So cotton prices. So when you're quoting your order, if you don't hedge, if you keep it as it is, you are taking market risk, because today I'm putting cotton prices at, I don't know where cotton prices are at. Let's just put a random number. Let's say you are putting your cotton prices to your product at 100, right? At 100. And you quote the order. And then when the actual contract, you win the actual contract and you have to actually manufacture and you want to get cotton down, you see that the prices have increased and therefore you will make your margins will come down, and sometimes you might even make losses depending on how much your margins come down. But if you hedge, whether through a forward or future, whether cotton prices go up or down, it doesn't matter. You have quoted a margin. Let's say 20% on your cost. So your cost was 100 based on a certain cotton price, and you quoted to your supplier, to your buyer, 120. So you know that you have a 20% margin on your product, right? If you hedge through a forward or a future, the cotton price, you know that no matter what, your cotton, you're going to buy at this price. So because of this, you are at an advantage that margin doesn't come down. Even though you could have made a higher margin, your margin is fixed. all that is happening is that there is an opportunity cost of you could have made a higher margin than 20%, but now your margin is, it's 20% and it's fixed, right? If you go for an option, you quote again with 100 and the 20% margin, 120, and you look for the cotton prices, and once you win the contract and you start to bring cotton down, you can either get a 20 margin, or if cotton prices started to come down, because you're not going to exercise the option, your margin can expand. But hedging creates certainty in margin. That's why you hedge.
Yeah, madam. That means ultimately you using option, we avoid making losses. Am I right to say that?
Yes, as long as you don't use exotic
Yes,
options,
yes.
then
Yeah.
you can. Only thing is, when you say avoid making losses, you remember that you have that premium that you have to pay, and that premium is high, and all that also plays a part.
That actually the premium, I have to make the decision, the trade off between the premium and the price movement. That
The
is
premium and the price movement. That's right.
Yeah.
Yes.
Yeah. That means these kind in a very high level, these kind of instruments are created to make the businessman or the executor to make more profitable angle than going to losses side.
It's more than profit, it's hedging, right? There is a difference, right? It's more than profit, it's making sure that you don't make, it's about, true, it depends on how you price it, but it's about making sure that you don't lose.
Sure. Thank you.
Okay, so let's look at the same thing that you were talking about, right? Now let's look at the next part of the same example. So this part, I have it again in a different page. So same example. Try this. So it's a continuation of the previous example. Now he has bought the call option from the previous example. Simultaneously, he's selling a put option. This part, right? So it's a continuation of the first part. 1 second, Viraj. Okay. Yes. That's per barrel. Payoffs and profits, okay? Fifty-five, yeah. No, remember 55 here. Your payoff in terms of the denomination is not correct, but per barrel it is correct, right? Profit is not. Look at the entire transaction. It's simultaneously he's selling a put option. Last time also 55, remember? There was a problem in terms of the denomination, the total cost. Yeah, Niraj. Tivanka, no, I think there's something wrong here. First do the payoff and profit, and then look at the ultimate cost. First payoff is correct. Second payoff is correct. Third payoff is not, right? Third payoff is not. Sorry, Niraj, third payoff is not correct for yours also, I think. At 90.
Excuse me, in that 90, the hold of the put option will not exercise, right?
Correct. That's correct. But he has two options with him, does he not?
And can't we assume that for the first one, regardless of price, his profit is 2 million?
Regardless of price. Okay. But you have another option in play. You had to look at everything together.
Oh, right. Okay. So payoff, you're looking for both.
Well, I'm not looking for both, right? You have two options with you. So you had to decide, you had to take action on each of the options. Right? So in this sum, you have now simultaneously sold a put option means you have purchased a call from the previous example. From the previous part, we have purchased a call, right? So you have an oil trader. He's a hold of a call option. And now he has simultaneously sold a put option. So he has two options with him. He has bought a call option and sold a put option. So he's a hold of a call option and a write of a put option. So for each of these different prices, both options are with him. So the entire gamut of what will happen has to be taken into account.
Meaning this payoff we are calculating for the second part should be both, net of both. Huh?
That's right.
Ah,
So just to make sure that, again, just to avoid confusion, right? This is a continuation of the first part. To reduce his cost, the trader decides to simultaneously sell put options. Why simultaneously means together, right? Simultaneously. So here, you're continuing from the first part. He decides to buy a call option. Sorry, I've written December here and then okay, so it's December, that's fine. I think here I haven't changed the example, no? Fine. So he's decided to buy December call option. So this is his transaction, right? He's purchased call options and simultaneously at an exercise price of 85. So he's the hold of call options at 85. and he's written put options or sold put options, meaning he's written put options at 80. This is his transaction. He's purchased call options at 85 and written put options at 80. Okay. So that's what this simultaneously means, together, immediately together. He has also sold put options. No, I think there's something wrong here. These are all December now. This in your example, I've given it right, but I haven't changed it here. So this is what is happening, right? You're coming from the previous example. So this is also not June, the December expiry call option. You have this oil trader. He wants to buy oil. He's scared that oil prices will go up. So he decides to buy a call option. Okay. So the first step in his process is that he buys a call option. He's the holder of a call option. Okay. Now, for this, he pays a premium of $3. Now, in the second step, in the first step, he is the holder of a call option at an exercise price of 85 and an option premium of 3. Now, the second step, he, together with that call option, he simultaneously sells a put option at 80. So he's the writer of a put option at 80. And the option premium for that is 3. Now, we'll see why he's doing this in a minute, right? But let's look at what is the payoff at 70. Now, what has happened? He's the holder of a call option. Look at the transactions. He's the holder of a call option. And he's the writer of a put option. Okay. Remember, call options look like that, and he's the holder. Put options look like that, and he's the writer of a put option. Okay. So this is the payoff diagrams. Now he's the holder of a call option at 85. And he's the writer of a put option at 8. Okay. Now, this is the payoff diagram. Now we're looking at the payoff. What is his payoff if oil prices at maturity are 70? Okay. So if oil prices at maturity are 70, correct, Niraj. Okay. So if oil prices at maturity are 70, now what happens? He has a call option and a put option. Because of the call option, you're here. Sorry, you're here. Call option, you're here. Call option, what happens? It expires worthless, right? Call option expires worthless because you are here. It is expiring worthless. So the payoff is 0 from the call option. From the put option, you are here. Again, is the payoff positive or negative? Is the payoff positive or negative? Why is it positive? Sorry, say that again. Put option. You're a writer. Yes. So correct. So now what happens then? Payoff is negative, right? Payoff is negative. So because you're a writer, otherwise, yes, true, but you're saying, but because you're a writer, now your payoff is negative. How negative is it? Payoff is X minus ST, right? Exercise price is 80. Market prices are 70. Payoff is negative 10. Negative 10. Here you can look at the graph also, you can see it's at 70 to 80, payoff is negative 10. So whichever way is easy for you, you can work out the numbers. So from the call and the put together, from the two positions together, the call and the put together, your total payoff is minus 10. If your market prices are 80, what happens? What happens to your payoff? For the call option, what is the payoff? It's still 0, correct? Because you're here. It starts to make profit from 85, not profit, positive payouts from 85. So it's still 0. For the put option, at the money, because it's at the money, correct? Because at 80, you are now at the money for the put option. So that's also 0. So the total combination is a payoff of 0. At 90, for the call, it's 5 rupees. Yes, because you're here at 90. So for the call, it's 5 rupees. Or you can think of it as ST minus X. All options are ST minus X as long as it's positive payoffs. So for holders, so ST minus X is ST is 90 minus X is 85. It's 5 rupees. And then for the put option, it's 0. So therefore, in total, it is 5. Okay. That's the payoff. What about the profit?
When small profit is checked in the first scenario at 70, that put option x minus xt, it's mean 80 minus 70. So how it comes minus?
80 minus 70 for the holder. This is the writer. But good catch. Sorry, I should have written it that way. It's x minus st for the holder. For the writer, it is negative. Thank you. Okay, so this is the payoff. Now, what does the profit look like? Wanted to tell me the profit for the call option, profit for the put option, and the total. Johan, why are you saying it's plus 10?
Because that 90 and 80, I took that difference.
But what do you mean by taking 90 and 80 difference? You can't just take it, right? You always have to, because that's where you'll get confused. Okay. You always have to look at the diagram or you have to look at the equation, one of the two. Otherwise, you get confused. Now, you are right off a put option. At 90, you're here. A put option at 90 exercise is worthless. Right? So therefore, it is 0. Does that make sense to you?
Yes, yes.
Okay. So now you are the hold of a call option. Option premium is 3. So how much is your total profits? You're the hold of a call option. What are your total profits? Sorry, say that again. Minus 3. Yes. Because your payoff is 0 and you paid a premium, so it's minus 3. For 80, your call option is And for 90, it is 2. Okay. So all I'm doing is taking the call option payoffs and I'm deducting 3 because I'm the holder of the call option. Right? So 0 minus 3, 0 minus 3, and 5 minus 3 is 2. For the put option, what are my payoffs and profits? Minus 7. Why is it minus 7? Okay. That's correct. So because this is a positive premium because you are a writer. This is a negative premium because you are a holder. So here you collect $3, like you said correctly. You collect $3. So minus 10 plus 3, it's minus 7. 0 plus 3, it's 3. And 0 plus 3, it's 3. Okay? So your payoff plus the premium because you are a writer. So when you add these together, what are your profits? Minus 3, minus 7, minus 10. Minus 3 plus 3 is 0. 2 plus 3 is 5. Do you see? There is a... It's the same. Payoff is the same as profits in this case. Why is that? Why are the payoffs and profits the same? Why are the payoffs and profits the same? That's correct. Yeah. That's exactly why you did this transaction, right? So some people do this transaction because they want to offset the cost. They don't want to pay anything when they're doing this options transaction. They don't want to pay anything. So what do? We create what we call this strategy is called a collar strategy, right? A collar. A collar is where you simultaneously buy a call and sell a put or buy a put and sell a call. Right? So you're doing the opposite side. You buy a call and sell a put, or you sell a call and buy a put. So this is a collar strategy. We call this strategy specifically a zero cost collar. Zero cost collar. Because the call that you buy, you buy a call and sell a put and sell a call and buy a put at two different strike prices. Two different strike prices. You see here, this is at 85 and this is at 80. And the two premiums are the same. Why are the two premiums the same? Because this person, what he wants to do is he wants to hedge oil prices going up. He wants to hedge that. He is a distributor of oil. He wants to buy oil, right? He's a trader of oil. He wants to buy oil. But although he wants to buy oil, he doesn't want to pay that premium. Options cost you. Forwards are free. Futures are free. There is no upfront cost. There is upfront deposit. But that deposit is part of your payoff anyway, right? It's a deposit. It's an advance of something you will receive in the future. This is a cost. The premium is a cost. It will be, it's sunk cost. Once you pay it, you can't recover it back, right? It is a fee. So sometimes some traders don't want to pay that fee. So what do? They create what we call zero cost collars. Zero cost collars are where you eliminate the premium by doing the exact opposite of the transaction. So here you are holding a call and writing a put at the same option premium. So the call price and the put price are the same. Because of this, when you hold the call, meaning you buy the call option, you have to pay $3. But because you're selling the put option, you receive $3 and they cancel out, which is why we call this strategy a zero cost collar strategy. You have collar strategies which are not zero cost. This is a zero cost collar strategy, right? So if I show it to you again, your call option profit right, is your call payoff minus the $3, right? And your put option profit is your put payoff plus the $3. So your total profits is your payoff from the call option plus the payoff from the put option, right? So the payoff from the call option is the call option payoff minus 3. And here it's the put option payoff plus 3. So minus 3 to plus 3 cancels out. So it is simply the call option payoff plus the put option payoff. Your call option profits and put option profits in this strategy, the payoff and the profits will be the same, right? Separately, you will have profits or losses on the call option, not loss, meaning profits or payoffs on the call option, separate profits and payoffs on the call option, and separate profits and payoffs on the put option, but together, the profit and payoff of the total transaction will be the same. Any questions here?
Vindhya, why would they have two different exercise prices for
Okay.
this? Yeah.
Hey,
Why would they have
that's
the same thing?
okay. So the exercise price. So this was I'll still come to that a little bit later. But the exercise price, oh sorry, you want to let me put it this way for now. Okay, I'll come back to it later. You want to have the same option premium, right? So the same option premium will not occur at the same exercise price. That's on the pricing of the premium, how we get this value. It will rarely occur at the same exercise price. So when you want to have a put option, when you want to have a zero cost collar where you want the premiums, the two premiums to be the same, these two prices will be different. Or you'll have to create, so I'll show you again in a minute. You'll have to create other synthetic positions so that you will have a price that is the same. Because the option price, what you pay, yesterday that question was asked, how do you decide the option price, what you pay? And that is a function of the current market prices, the exercise price, the volatility of the underlying asset, right? So it is a function of a lot of things together. How volatile, the standard deviation of the underlying asset, right? Like, for example, gold prices, gold might be more volatile than something else. Okay. So any options on gold versus silver versus copper will have different volatilities. It will depend on the current market price. It will depend on the exercise price, right? How, for example, the closer you are to the money, the higher the price you will have to pay, the option premium you will have to pay. Because the higher the propensity for the loss for the write off the option. You understand that? The more you are at the money, the closer you are. When you take a call option or a put option, right? Let's take a call option. The closer to this area you are, the higher the option premium. The further away you are, the lower the option premium. Okay. Sorry. My mistake. Sorry, should we just say that again? My mistake, that's wrong. The further away you are to this side, lower the option premium. But here, right, do you see the hold of the option makes massive gains? So the more closer you are, the higher the exercise price is, right? What will happen? You will have higher premiums because it's about the fact that the writer also doesn't want to lose. The writer is also putting probabilities and saying, based on these probabilities, this is the price I'm going to charge you. He's not going to put a probability where he thinks he's going to make losses. From the writer's side, this is what his diagram would look like, right? His diagram would look like this. And when he charges you money, his diagram would look like that. But he wants to make sure that he is in this region. Okay. Therefore, he will do everything to make sure that he is in that region. So when you want to buy something, like a call option, lower the exercise price. Now, let's say, for example, this is a call option on some company X, right? Some company X, and the current market price of this company is 100. Okay? The closer you are to 100, that means, let's say you want to buy this at 90. Obviously, you're in the money, right? Market price is 100. You want to buy this at 90. So what is going to happen? Your premium is going to be very high. But if you get into a call option that is at 120, then your premium is going to be lower. Your premium is going to be lower. Why? Because now the writer knows, okay, today the prices are 100. The price to go from 100 to 120, chances are lower. So versus 90, right? So versus 90. So the premium is going to be lower. Closer the time to maturity, premium is going to be higher, depending on how close you are to or how much in the money you are. Longer the time to maturity, it depends on where you are versus in the money. Then volatility. For example, higher the volatility, higher the chance of you going to 120, right? Because the prices can fluctuate like that, higher the chances of you achieving that 120, in which case your premiums are going to be set at higher prices. Remember, the writer never wants to lose, right? He's going to give you that option, but he's going to make sure that he's positive and you're negative. Just like you are going to make sure that you're positive and the writer is negative, the writer is going to make sure that they are positive and you are negative. The holder is negative. Right? So therefore, the price is a determinant of multiple factors. How close it is to being exercised increases the premium. How further away it is from being exercised, it decreases the premium. So therefore, it's highly unlikely that the premiums will be the same at the same exercise prices, okay? Which is why you see that this excess will be different. Actually, let me just show this to you. Let me talk about a couple of things. Any other questions before I move? I'm going to just show a few examples or talk about a few examples. Any other questions within this example? Correct. Absolutely correct. Yes. So this strategy would work because now you are holding a call option at 85, right? And you are selling a put option or writing a put option at 80. If I combine this together, it looks something like this is negative, this is 0, this is 0, this is 0, this is 0, this is positive. So it looks something like that. Okay. So this strategy would work if you don't think, because you are trying to buy oil and you're saying above 85, I want to fix my costs. I don't think oil will fall below 80. If oil falls below 80, he's actually going to lose out because his costs are going to increase, right? So actually, we didn't finish this example, no? We had the second part, payoff, profit, and ultimate cost. Okay, we finished that also before I discuss the next bits. Ultimate costs. For each of these scenarios, what is the ultimate cost of buying oil? Yes, don't nudge. That's right. Correct. Ravindran, yes. Devankar, yes. Okay. So here, now at 70, what is happening here? At 70, you have a call option and a put option, and oil prices are now 70. So when oil prices are 70, you can buy it in the market at 70. So it costs you $70 per barrel to buy it in the market. In addition, because of the call option and the put option, there is another additional cost of $10. So what is the price of oil to you? What is the cost of oil to you? It's $80. When actually oil prices in the market are $70, the cost of oil to you is $80. Why is it $80? Because there's an additional call option and a put option that's increasing your costs, right? Even in terms of profits, because there's no difference between payoffs and profits, it's $80. So let's talk about it in profits because that's your ultimate. When prices are 80, there is nothing that you get from the call and the put, total is zero. So the oil cost is still $80 too. But when profits are 90, you get back $5 because of the call option and the put option together. You get back $5, right? So therefore, your cost is 85 a barrel, or in total for 1 million barrels, 80 million, 80 million, and 85 million. What do you start to see here? So you said we purchased a call option at 85. We sold a put option at 80. So this was what it kind of looked like. And then we had to look at the oil prices also. What do we start to see? When oil prices fall below 85, when oil prices start to fall below 85, okay, at 80, the cost to me is the oil trader is 80, right? Is 80. When prices are 70, the cost to me is 80. When prices are 90, the cost to me is 85. Cost to me is 85. So what do we see? As long as the prices are up to 85, the cost to me is 85. Below 80, the cost to me is 80. To the trader is 80. Between 80 and 85, actually, you can do the calculations and see this cost will keep increasing until it is 85. Okay. Let me draw that again. Please tell me if it is confusing you. So from the call option and the put option, I have this, the fact that I am getting a negative payoff because the put option. During this period, I am getting nothing. And during this period, above 85, I'm actually getting a positive payoff. This, in effect, creates a ceiling on the price that I pay. As a oil trader who's purchasing oil, because I have the call option, my oil cost is always going to be 85. Because I have the call option at 85, my oil cost is always going to be 85. And when oil prices come down below 85, because I have the call option, technically, I should be benefiting. My cost is going to be whatever the oil price is, right? Except, and especially because there is no additional fees because of the zero cost collar, +3 and -3, no additional fees. So it's going to be exactly what the oil price is up, right? But if oil prices fall below 80, because I went and tried to reduce my costs due to a zero cost collar, if oil prices fall below 80, my costs don't, my actual cost of buying oil doesn't fall below 80. I'm stuck at 80. There's a floor. So that was the question that you were asking. Yes, that is what happened. And this is what happened in the CPC hedging deal as well. CPC went and purchased a zero cost collar. If you all remember the CPC oil hedging deal, right? So in 2007 or 8, right? 7, I think. There was this whole problem that came because saying that there was corruption and CPC has gone and done hedging, and these hedging deals have created situations where we are paying more for oil than what was expected. So because just before, right, let me show you that those case study. Just before this whole problem happened, oil prices were really high. Okay. So just before this whole problem happened with CPC, hope you can see, oil prices were going up quite a bit. And with these prices going up, see, you can see here that oil prices actually were touching like 125, between these 125, 150 levels, right? So we were seeing very high oil prices, 100 to 140 type of oil price levels, something that was unaffordable to us, which was the reason CPC started hedging. Now, with hedging, the problem is, so they started hedging, and then I think the first few hedge deals that they did were not problematic. But one of the things that they did too was they got into zero cost collars. Right? Zero cost collars are good to the extent that you don't have to pay anything. Now, if you just bought a call option because you are scared oil prices will go to 150, 200, people were really worried about what would be happening to oil prices at that time. The forecasts were like it'll hit 200 or it'll hit 150 or right. So for a country like Sri Lanka, obviously it's not something that is affordable to us. So hedging was something that was required. Now the problem with government hedging sometimes also comes to the fact that if you start to pay fees for it, there can be allegations of corruption again, right? So it depends on how you pay, what you pay, right? So if you start to pay fees for it, there again can be allegations of corruption. So one of the things that was approved for CPVC was to go for a zero cost collar where you don't have to pay any fees. But remember, there is no free lunch, right? Just because you don't have to pay fees doesn't mean you're not taking risks. So it's fine as long as you're within that collar. Remember, you saw that collar where from 80 to 85, right? From 80 to 85, the oil prices were moving with the market. Above 85, you were able to purchase at 85 in our example, but below 85, below 80, no matter how much oil prices came down, you were still paying 80. Okay. And this is what happened to CPC. In 2007, 2008, the global financial crisis happened. One of the biggest recessions globally, oil prices crashed. And you can see massive crashes happening in oil prices. CPC has already gotten into a hedge contract where they were in a zero cost collar. Zero cost collars means when oil prices crash, you are still stuck buying oil at those high prices, at, in my example, $80, right? The problem here was not the fact that they hedged, but how the hedge was created, right? So there were again allegations of corruption, and I'm not going to get into that in terms of whether there were corruption or not, top payments or whatever, but how that hedge happened. Why? in terms of the zero cost collar, right? So I'll share this link with you. It's a good reading for anybody who's interested. You can see here, when CPC entered into this zero cost collar, the collar had a ceiling of 130 and a floor of 100. So this is exactly the type of example that we did, but instead of 85, the call option was purchased at 130 and the put option was purchased at 100. Sorry, what do I say? CPC wrote the put option at 100, right? CPC wrote a put option at 100 and held a call option at 130. Now, the thing is, the ceiling meant that if oil prices went above 130, no problem. You will get 130. But the way the transaction was structured was that the 130 was there for 3 months. Right? Meaning, after oil reaches that 130 and you're in the money and you're able to buy oil at a ceiling of 130, even if oil prices are 150, even if oil prices are 200, that ceiling was only valid for 3 months, right? There was a time limitation. However, when he wrote the option, CPC allowed the bottom, right, the floor, meaning that $100 that the put that they sold, that was valid for 12 months. CPC allowed to buy a maximum of, so the way that they created the zero cost collar of 100 to 130 was by manipulating these numbers, right? So you could only be above or only get that advantage for 3 months and for a maximum of 100,000 barrels a month. But when CPC wrote the collar, they wrote the put at $100 a barrel for 12 months, and they promised to buy 200,000 barrels a month. 200,000 barrels. So here you're kind of stuck in a place where at $100 a barrel, now oil prices have crashed below 100. You can see that like $50 a barrel. And for 12 months, we are buying oil at $100 a barrel twice, and we're buying double the capacity or double the required amount or whatever, right? That was where the problem started. And then there were allegations of corruption of why you entered into this type of deal and all of that. But this was the hedging fiasco that happened with CPC. And you can read through the case and see. But it happened because of a zero cost collar. Zero cost collars are good if you want to reduce your cost. But remember, reducing your cost, there is no free lunch. Reducing your cost comes with consequences. And this was the consequence. The problem was when these underlying assets prices came down, you're still stuck at the high price because you chose not to pay the fee. If you just bought call options only, you would have had to pay a fee, but you would have been okay. In terms of when oil prices come down, you would have been okay. You have to understand, though, at that time when these deals were happening, oil prices, all analyst forecasts, consensus estimates, everything was about oil prices going up. Oil prices going up. And in terms of the probabilities of oil prices coming down were quite low until Lehman Brothers collapsed, AIG collapsed, and this global financial recession started. And suddenly demand crashed. And you saw oil prices not just going down, but going down more than 100%, right? So, 50, right? So you halved. And that was where big problems started. So another thing that I want to show you, I hope you can see see here, if you remember last CME group, we spoke about the different types of futures contracts that there are, right? So you had like these futures contracts on agriculture, crypto, right? Different interest rates, foreign exchange, energy, all of that. So this was the futures contracts. So these are some gold futures contracts, right? And we spoke about how the high-low settlement prices and all of these. Each of these futures contracts, for every futures contract in the CME, there is an option that is available, an options contract that is available. So for example, if you go to the August gold futures, this futures price has an option inside it, available if you want to, if you choose to go for the option versus the futures, you can do that. For every one of these contracts, there is an option available. So if we go to the August options, this is an option on the future, option on the futures contract. Okay. So what happens is you take an option to buy or sell the futures contract at a certain point in time. So here you have the underlying futures contract. The underlying contract is the gold futures contract expiring in August. That's the underlying contract. Last traded price, 2,416, right? Gold prices. So expiring in August, somebody is saying gold prices will be somewhere around 2,416. That's the last traded price. If you look at the options prices, you have the call options and the put options at different strike prices. So what are these? For the August futures contract for gold, expiring in August, there are options expiring in August with a strike price of 2,415. So here, instead of buying the futures contract, you buy an option where you say, I want to have the option to buy gold or sell gold, depending on whether it's a call or a put, at 2,415. This is the strike price, the exercise price, right? The strike price. And do you see the options prices here? High, low, last price. Do you see here? Now, futures prices are somewhere around 2,400, right? 2,416. So 2,415, that's why this is highlighted. This is like at the money, exactly at the money type of price. This is the call price 26. This is the put price 22. As the prices increase, right, the strike price increases, X increases, 2,415 to 2,430, the put price increases, the call price comes down. The call premium comes down from 26 to 20, from 22 to 30 for the put. Why is that? As the strike price increases, the call price, the call premium comes down, the put premium goes up. Why is that? Correct? You're going to sell at a better price, right? Correct, exactly. So the put price goes up because you want to now sell at a higher price. This is not the current market price because this is on the futures of gold, right? This is not on the gold, but on the futures of gold. But you want to sell in August gold at 2,430. When gold futures, somebody is willing to execute at 2,460, right? So the higher the probability of you making profit, the writer will want more money from you. So the price, the premium increases. But you want to have the right to buy gold at 2,430. Right now, gold is 2,415. Higher the price from where it is now, lower the call price. And lower the price from where it is now, higher the call price, lower the put price. So similarly, I'll show you CBOE. CBOE is the Chicago Board of Options Exchange. This is the options on the S&P 500 index, the S&P 500 index. So the S&P 500 index, this is the S&P 500 index movement, right? So right now, S&P 500 is at 5,612. This is like the SPI, the S&P 500 index. And you have options on the S&P 500 index. So you can see this is the index. This is the actual underlying. Okay. Closing price 5,615. So the option range near the money, you can have the option range of all. I'm just going to go near the money or at the money options, right? So closer to 5,615. That's the last traded price. Okay, that's to 5,615. Okay. So these are the call options. These are the put options. And this is for options. So they're showing July 12th. Forget that. Options expiring July 15th, July 16th, 17th, 18th, 19th, 20th. You'll see for every day in July, there is an option that's expiring. Then for every day in August, September, October, November, up to December 2029, you can have options on the S&P 500 index, right? You can quote for it. Some will be more active than others. And if you look at, let's say, options expiring July 30th, the call prices and the put prices, you can see here, the call prices are higher, lower the strike price and lower, and lower, higher the strike price, right? So because what are you saying? You have the right to buy the index at 5,630 on the 30th of July. And here, put prices are higher the index and lower, what am I saying? Prices are, it should be, I think this is a different, this is some anomaly that depends on the trading, but technically, as well as the volatility, but technically higher the exercise price and lower the exercise price. Okay. Any questions here? So you can have options. I'll just show you options that are so you can see for September, the call prices, even with S&P strike price of 200, this is as you come along to 5,600, right? 5,615, this is the money. And then it will go up to even 9,400. You have ranges, right? Closer to the expiry, the range shortens. But as you can see, longer the expiry, there are higher ranges that are offered and people trading on them. Okay. So it's 10:25. Let's take a break. And we'll come back afterwards. 10:25, 10:45, 10:45.